Well, the Fed has decided that they want to pull out all the stops to reduce market and economic volatility. I think that was what really got them going in the later part of March and early part of April, was that markets, not just the stock market, but commodity markets, junk bond markets, interest rate markets, were experiencing really persistent and elevated volatility. And they just kept throwing things at it to make the volatility stop. And of course, when investors use the word volatility, what they really mean is down. Prices going down a lot. And the Fed came in because there was a total seize up in really the credit market system around the world, but of course relative to the Fed in the United States. I've been in the market for 35 years, and I've seen all kinds of crises, including I was right at the front lines during 2008, 2009, during the global financial crisis, which really hit the securitized asset sector. And what we experienced in the last part of March was far worse in terms of market conditions in the investment grade corporate bond market, in the emerging markets, certainly in the junk bond markets, far worse than the very worst day in March of 2009. Literally, in 2009, you could get a bid, you didn't like it. The prices were in a free fall from the day before on the really ugly days of maybe 10 or 15% price moves to the downside in a single day. But in March of 2020 here, there was no bid. There were actually situations in large swaths of the fixed income market where you simply could not sell assets. And that led to what looked like was going to be some very substantial bankruptcies in some of the leveraged pools like mortgage-related REITs and other leverage types of investments. And the Fed just figured that at desperate times, they required desperate measures, and they went all the way into buying corporate bonds, which, as I've said in my webcasts, is not allowed under the Federal Reserve Act of 1913. And they did not buy corporate bonds during the global financial crisis, even though I know for a fact they talked a lot about it, because I know people that were inside the Fed at those discussions. But what they're doing is really a bridge further than they've ever gone before, where they're not even following their own charter, which means that the Fed could go even further in violation of the Federal Reserve Act of 1913 if they really feel like, we go into another economic move down. So the Fed has propped up the economy with just the most incredible fiscal lending that they've ever contemplated. And of course, I think the listeners know that the quantitative easing that the Fed has done since March is greater than all of the quantitative easing that they started back, in the global financial crisis. It was more in just 3 or 4 weeks than that entire program that was laid out over a multi-year framework. So that shows the level and extent of their commitment. In a certain sense, I think we're delaying the inevitable, because under my analysis, many bond prices that have been pushed up by the Fed's buying of ETFs and then individual corporate bonds more recently, the prices they've pushed many of these assets up to, I think, is a higher price that they're actually paying for them than you'll receive through a bankruptcy workout when a lot of these companies have to go through a filing. Also, as I talked about in the past, we probably talked about this in our last interview, the fraction of the corporate bond market that's investment grade and is the lowest tier of investment grade, which is triple B, is really enormous. It's basically half, or now even more than half, of the entire, it's like a $12 trillion market now. There's been so much issuance of corporate bonds, and the prices have been propped up to levels where I think the owners that own them at these levels will end up losing principal on a basket of these assets. So to that extent, they're delaying the inevitable. In the meantime, they have a lot of wherewithal to continue delaying, because they are spraying money all over the place and buying all these assets. The one thing that's happened that a lot of investors aren't aware of relative to their corporate bond activities is, at first, it really popped the prices of UDE, which is the investment grade ETF, and JNK, which is the junk bond ETF that I followed. And since then, the price of HYG is not really even up. since April 9th, when they really went full in. I think they announced corporate bond purchases as a strategy around March 23rd, but they really upped the ante in a meaningful, very meaningful way on April 9th. And since then, those prices haven't really gone up. They fluctuated, but they're pretty much unchanged. Meanwhile, that has led investors that understand that the price of corporate bonds today isn't really real. There's no price discovery mechanism that's being pegged. There's no message. There's just a target price that the Fed has been doing. And that led to a pop up in corporate bonds. But since April 9th, which is now we're moving on to about 3 months, the sectors that were left behind to fight for themselves, like the lower tiers, commercial mortgage-backed securities or asset-backed securities, and some emerging market bonds, they've really outperformed corporate bonds because they're catching up as investors realize that the interest rate profile of investment grade, like the LQD, is very long. I mean, it's about an 8-year duration, so it's about the interest rate risk of almost a 10-year treasury, and yet the yield to no losses is about 2.25. So there's not a lot of reward there, and there's a lot of risk if those bonds get downgraded, because the yields on junk bonds are far higher today than the yields on BBB corporates. So if they get downgraded, we know that the pricing is going to suffer very significantly. So in that way, the rating agencies might have an influence that the Fed can't really offset that easily, because those downgrades lead to probably about a 200 basis point spread widening, which means about a 15-point price drop if the market starts to factor in the potential for the credit quality reevaluated to the downside. Well, I'm glad that the Fed acknowledges that they have highly accommodative monetary policy. It's staring you in the face, of course, and it would be disingenuous for them to not admit that they have really put the pedal to the metal. And they're right that the economic activity, everybody knows this, for the second quarter is going to be terrible. The Atlanta Fed's GDP now shows an annualized decline during the quarter of about 37%. That's actually improved. It used to be more like negative 45%, but that annualizes to roughly a 10% drop off in economic activity for the second quarter. So yield curve control is something that the Fed has been telegraphing. Jay Powell, and I give him credit, Jay Powell, which are words I don't speak very often, that I give him credit, but I give him credit for talking strongly against negative interest rates. And so he says that in the next recession, which of course we're in, that he doesn't want to go to negative interest rates. You can't go to negative interest rates in the United States without a total catastrophe, in my view. So I'm glad he says that. So what's left is yield curve control, which they're talking about, which is just a code word for suppressing interest rates. There's precedent for this. They did it in the late 1940s and the early 1950s at interest rate levels that weren't that dissimilar to where we are today, in a way to help manage the World War II debt. So what's interesting is to watch the 30-year Treasury. I know in the minutes there, Brian talked about the 3 and the 5 year. They already look like they're being pegged to me. They're at very low levels. But what seems to be a little bit left to fend for itself is the 30-year Treasury bond, which has gone up in yield from its low close by about 43 basis points, and from its intraday low by about 70 basis points, which is actually a pretty big loss. If a 30-year Treasury bond goes up in yield by 70 basis points, you lose about 15% or 12% or so, which is a pretty big loss. So the 30-year Treasury bond, if left on its own, will be going higher. And the real signal to watch for is what is the level at which the Fed really gets uncomfortable with the 10-year, but in particular, the 30-year Treasury bond yield. Because the amount of debt that needs to be floated, the Fed has done quantitative easing, but we have a lot more debt coming. I mean, we keep still hearing about multi-trillion-dollar rescue packages. And don't forget, we have one of the programs, I think it's the $600 program, is running off, I think, at the end of July. And there's other assistance that runs off at the end of the year. And it's going to be a really big question as to how the economy can handle the taking away of direct monetary payments to American citizens that are, don't have any savings and are in economic distress. So if you didn't have the Fed manipulate the 30-year Treasury bond, I think with all the supply that's coming, if we're allowed to actually float into the market, the rate would go quite a bit higher. But there'll be a level at which I think the Fed decides to do that yield curve control and therefore suppress that interest rate. So it's a very tough environment for investors because there are no market signals. There's just targeted assets and targeted prices for many sectors of the market. And the only way to succeed as a fixed income investor is to really, unfortunately, have to put in a tremendous amount of time and energy, and with a lot of people working on it, into the areas that the Fed is not supporting. And when I talk about that, a lot of investors get really nervous because the things that the Fed isn't supporting are areas that have a lot of economic question marks around them, like commercial mortgage-backed securities, like credit card receivable debt. These types of things, I think we all know that some of these forbearance and some of the non-payment is likely to continue to increase over time. And you have to kind of understand that you're likely to take losses from par on some of these securities. The good news is that we don't think the losses you're going to take are beyond what the discounted prices are already, because everybody knows that these sectors are in really big trouble, or at least certain particularly hot spots of them are in truly big trouble, like hospitality, cruise lines, and the like. But that's what you have to do. And investors are reluctant to go into fixed income securities when they think there's any risk. There's always risk, of course, but when they can see the risk, they get afraid. But that's why the prices are down. It's the paradox of investing. People don't like to buy low. They like to buy high when the sun looks like it's shining and the sky is blue. And when it looks like there's a hurricane coming, they want out. But the hurricane is priced in when you know that it's coming. And so it's a tough environment for standard investment types. I'm glad that we at doubleline have always had sort of a differentiated, more creative investment style, because it's suited to this type of environment better than more traditional, or certainly a passive investment style, which looks like almost doomed to fail in the environment that we're in.